Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nokia stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 22 billion market cap. They're trading at $4 a share, and they have 5.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2021 at 2.3 billion. It was under 1 billion in 2022, and it's pretty close to zero in the trailing 12 months, only 42 million. You can see their net income is pretty high, 4.6 billion. This implies they're investing a lot back into their business through CapEx, which is why they have such a small amount of free cash flow. Net income is a profit or loss on the income statement. It's revenue minus expenses. Lots of write-downs in 2020, so they posted a big loss. Positive 1.8 billion in 2021. Then it grew a lot to over 4.5 billion in 2022. Same thing in the trailing 12 months. They report their numbers in euros, but since we're looking at the ticker that trades in the US, I converted all the numbers to US dollars. Revenue is a sales for the company, and that looks really good, growing from 24 billion to 28 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 26 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $22 billion. We divide that by 5.6 billion shares. And we get a calculated stock price of $3.93. They're trading at $3.94, so they're trading exactly at intrinsic value. I think this is the closest my model has ever been to the actual stock price. I did a video on Nokia a few months ago in March. They were trading at $4.63 back then. My target was $3.23. So you can see the stock came down a good amount since then. It's down to $3.94. But now my target has come up a bit. It was $3.23, now it's $3.93. As you probably know, valuation is an art, not a science. Especially with moving interest rates. Rates were really high a few months ago. They've come back down a little bit. So predicting the future is really hard to do. The way I like to look at it, if a stock is a screaming buy, I'll buy it. If it's a screaming sell, I avoid it. But when it's in between, when I'm not too sure, then you can flip a coin or just move on to the next stock. There are 64 companies in the same industry as Nokia, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 744 million in CapEx. These are investments in property, plant, and equipment. Hewlett-Packard is number 1 at 2.7 billion. They have a really good debt to equity ratio, only 0.2. So for every dollar of equity, they have only 20 cents of debt. Look at Motorola, 27.4. That's a really high debt to equity ratio. Nokia pays a nice dividend, 3.3%, the highest on this list. The average is 0.9%, the median is 2.8%. They generate hardly any free cash flow, but it is positive, the median is negative. They rank 4th in market cap. Cisco is the largest by far, over 200 billion. Then Motorola, 49 billion. Hewlett-Packard, then Nokia. The proper way to pronounce the name is Nokia. In the US, we usually say Nokia. Their price to book is 1.0, so that means their equity is equal to their market cap. Equity is assets minus liabilities in the balance sheet. A really attractive PE ratio below 5. That means investors are paying $5 for $1 of earnings. Their price to free cash flow looks pretty weak because they have such a small amount of free cash flow. Their price to sales is below 1, so that means their revenue is higher than their market cap. They released their earnings last week, and they missed on revenue and missed on earnings. The last 2 quarters they did beat revenue, but this quarter they missed by 1.7%. The market expected 5.8 billion euros. They actually reported 5.7 billion. Let's go through their second quarter earnings slides. Their Q2 sales were down 3% from the prior period last year. Enterprise sales grew 27%. Their gross margins are getting worse, down 2%, 200 basis points. Operating margin down 1.3%. It's currently 8.3%. Second quarter free cash flow negative 400 million euros. Their revenue forecast for 2023 is 23.2 billion euros, up to 24.6 billion. They project an operating margin for 2023 of 11.5% to 13%. Their sales this quarter were 5.7 billion, down from 5.9 billion last year. That's a decline of 3%. In the first 2 quarters, their revenue is up from last year. It's up 3%. The first and second quarter of 2023, revenue of 11.6 billion. The first and second quarter of 2022, revenue of 11.2 billion. Gross margin 38%, down from 40%. Operating margin of 8.3%, down from 9.6%. EPS is also down. It's 5 cents compared to 8 cents last year. Here's a breakdown of their revenue by category. For network infrastructure, revenue of 2 billion. It was 2.15 billion last year. Mobile networks is up. It's 2.6 billion. It was a little under 2.6 billion last year. Cloud is 742 million. Nokia Technologies 334 million, up 10% from last year. Their gross margins improved a lot in network infrastructure. It's 37.1%. Last year was 35%. Gross margins are only 33% in mobile networks. It was 40% last year. Let's take a look at their balance sheet. Non-current assets of 22 billion. Their largest asset is goodwill, 5.6 billion. Goodwill is the premium you pay when you acquire another company. Actually, their highest asset is pension assets, 6.5 billion. If we were looking at a US company, current assets will be on top, non-current on bottom. But for European companies, it's opposite. Non-current assets on top, current assets on the bottom. It's listed from least liquid to most liquid. The most liquid asset is cash. They have 5.1 billion. Their current assets are 18.5 billion. Current liabilities of 8 billion. So their current ratio is above 2. Their total assets are 40.7 billion, down from 40.9 billion. Their largest liability is accounts payable, 4.3 billion. This is what they owe other companies for buying on credit. Let's look at their statement of cash flows. For the second quarter, they had operating cash flow of negative 333 million. Last year it was negative 43 million. So they're losing cash from running their day-to-day business. That's not a good thing. They spent 127 million of PP&E. These are investments in property, plant, and equipment. In their financing section, they spent 167 million in dividends. These are the dividends they pay to common shareholders. Last year in the second quarter, they paid 115 million of dividends. They've done 5 stock splits. The most recent one was in 2000, a 4-for-1. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,000 today. That's only 2.5% annual return, a 29% total return. Let's look at the stock on Simply Wall Street. Its last price was $394, 22 billion market cap, down 23% in the past year. Let's learn about the company. Nokia provides mobile, fixed, and cloud network solutions worldwide. The company operates through 4 segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. It offers products and services for radio access networks and microwave radio links for transport networks, and solutions for network management, as well as network planning, optimization, network deployment, and technical support services. They provide fixed networking solutions such as fiber and copper-based access infrastructure, Wi-Fi in-home solutions, and cloud virtualization services. IP networking solutions including IP access, aggregation, and edge and core routing for residential, business, mobile, cloud, and digital industry applications, as well as software-defined WAN solutions. A portfolio of optical networks comprising portfolio coherent optical transponders, optical transport network switchers, wavelength division multiplexers, reconfigurable optical airdrop multiplexer solutions, and optical line systems for metro access and aggregation, data center interconnect, regional long-haul, ultra-long-haul applications, and submarine networks. It also offers cloud and network services, including core network solutions such as voice and packet core, business applications, which covers security, automation, and monetization, cloud and cognitive services, and enterprise solutions covering private wireless and industrial automation. Further, the company provides hardware, software, and services, as well as licensing of intellectual property, including patents, technologies, and the Nokia brand. It serves communication service providers, web scales, hyperscalers, digital industries, and government. They were founded in 1865 and headquartered in Espoo, Finland. Here's some of the risks they list. Earnings are forecast to decline 15% for the next 3 years. High level of non-cash earnings. Dividend not well covered. They were trading at $1.50 in 1994. In mid-2000, they peaked at $60. Then over the next 2 years, the stock went down a lot to below $15. Then it had a nice run up to about $40 in 2007. But ever since then, the stock has struggled a lot. Simply, Wall Street's valuation is $536. They say the stock is 26% undervalued. In 2012, their trailing 12-month revenue was 32 billion euro. It fell to 2.5 billion euro in 2013. Then they revised their business model and their revenue started growing again. It broke through 20 billion in 2016. And since then, it's been fairly steady. It did go up a little the past few years, mainly due to inflation. It's currently at 25.2 billion euros. And the forecast is for their revenue to be 25 billion by 2025. So not much growth. The red line is their debt, the green line is their cash, and the blue line is their equity. So their debt is always lower than their equity. And they seem to have a lot of cash on their balance sheet. At any point in time, they could pay off all the debt with the cash on their balance sheet. Their equity has gone up a lot over the years. They currently have 4.2 billion of debt, 21 billion of equity, and 7 billion of cash. So their debt to equity ratio is 20%, which is really solid. They pay a good dividend of 3.3%. The industry average is 3%. And their payout ratio is 16%. Earnings of 75 cents. Dividends of 12 cents. Back in 2017, they were paying a 4.5% dividend yield. In 2020, they cut their dividend to save money, but the forecast is for the dividend to grow to 5.5% by 2025. Pekka's annual salary is 1.3 million euros. Total compensation, 9.5 million. His tenure as CEO is 3 years, but he has a long history with this company. 50% of the company is held by the general public, 43% by institutions, and 5% by VC and private equity firms. Their biggest shareholder is BlackRock at 6.5%. They did have more employees in 2012, over 100,000. Then they changed their business model and cut half their employees. It was down to 56,000 in 2015. Then they added a lot back. They've been scaling down over the years, eliminating their segments that are less efficient and just focusing on the more efficient ones. They currently have 87,000 employees. They're by far the largest employer in Finland. The ticker trades on the pink sheets, the Nordic Exchange, Deutsche Börse, Euronext Paris, Swiss, London Stock Exchange, Borsa Italiana, the Stockholm Exchange, Xetra, Prague, BATS Europe, the Vienna Exchange, Bulgaria, New York Stock Exchange, Mexican Bolsa, Börse Stuttgart, Xetra, Deutsche Börse, London Stock Exchange, Buenos Aires, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Thanks for watching.